Oil prices are rising amid heightened geopolitical risk in the Middle East and in Russia and Ukraine. Investors are concerned about tighter global supply, just as a shrinking U.S. rig count adds to upward price pressures. Brent crude is now trading nearly at $86 a barrel, WTI at $81 a barrel, and both prices are up 1% today. Early on Sunday, Russia attacked critical infrastructure in Ukraine's western region of Lviv. That was a major strike that saw one Russian cruise missile briefly flying into Polish airspace, according to Warsaw. Moscow launched 57 missiles and drones in the attack. It also targeted the Ukrainian capital, Kiev, 2 days after the largest aerial bombardment of Ukraine's energy system in more than 2 years of fully fledged war. Let's now speak to Erkin Sahinoz. He is the Chief Economist at FTD and former Fed economist, and he joins us now live from Istanbul. A pleasure having you with us on the program, Professor.
Nice to be here as well. Thank you very much.
Right, so Russia accounts for some 10% of the oil's global trade and production, but oil prices, the movement for now, has really been contained despite geopolitical tensions. Why is that the case?
Well, as you know, oil prices have been rising amid expectations that an Israel-Hamas ceasefire was imminent. There are also, signs of smaller inventories and fuel supply disruptions, which are also presenting a tighter outlook for crude markets. Last week, we saw that a stronger dollar had also weighed on oil. But losses were immediately held back by expectations of tighter supplies in 2024, while the strength of U.S. economy also presenting a positive outlook for demand. Well, let me look at the supply side before we move into the demand side as far as oil is concerned.
Right.
On the supply front, reduced Russian fuel output following Ukrainian strikes on major refineries points to lower oil product supplies in the coming months, that's for sure. And the Russian-Ukraine war also shows no signs of de-escalation. And on the other side, U.S. inventories have been steadily shrinking in recent weeks, with steady drawdowns in fuel inventories also reflecting improved demand in world's largest oil consumer. I'm talking about U.S. economy. And also the oil rigs, last week fell by one and indicating weaker production.
Right.
While increased travel demand also saw jet fuel consumption increase over the coming months as well. So the prospect of put oil prices on upward pressure in the upcoming months for sure.
Right. Before we get to the demand side of the problem as well, I'd like to ask you, what do you expect will happen to oil prices? Because some analysts are now talking about a potential $100 a barrel, especially for Brent, to be reached in the next few months because of heightened geopolitical risks. Do you agree?
Well, it is possible because global demand for energy remains high. If you look at the largest consumer, I'm talking about China, it has shown confident retail sales and industrial production sector data and a very stable outlook for oil demand this year. And not only that, apart from all the supply issues that we're talking about, we're also going to see the Fed will be lowering the rates this year. As you know, they raised the funding rate to a 23-year high of between 5.25 and 5.50% as part of a to bring high inflation back down firmly to its longer-term target of 2%. But this year is going to be different. Fed officials used public appearances, that they may move as early as June this year. And right now giving a 74% likelihood to a possibility of a rate cut in June meeting, according to the CME Group. This will also, apart from supply issues and a stronger than expected global demand, I would also like to mention that the Fed will also impact oil prices positively in the upcoming months. So $100 a barrel is a very possible trajectory for oil prices.